Thanks for tuning into Talking Point. It's turning out to be an interesting day of trade simply because the markets are bobbing between giving up the gains to getting the gains back again. Look at the intraday chart of the Nifty and you will see what I'm talking about. It started off okay, then gained a little bit, then cooled off a bit, and now again back in the green about 0.21%. Nifty IT is leading the way after starting off 1.6% higher. IT is now up 2.5 or 2.25% higher. So really strong show there, masking the disappointment, if any, that might be coming in due to banks. Ajay Srivastava of Dimensions Consulting joins us right now with his thoughts. Ajay, thanks for being patient with us today. TCS conversation took up some time. But I would love to understand from you, Ajay, what do you think of what Accenture did, finally what TCS has said, and this resultant uptick that we're seeing in IT stocks since the June 20th and getting amplified today after the TCS commentary?
See, first of all, I think whether we like it or not, IT is the best sector for India is concerned, right? We may not be in the cutting edge technology, but in services, we are the number 1, 2, 3, 4 in the world, and we've done a decent job with it. And as TCS has shown, India is just starting off to add as a geography for IT companies. I think more of them will start to focus on India when they realize that what TCS did to build itself out is not going to become a regular phenomenon. Plus, India's BFSI space will need a lot more technology investment with RBI coming heavily on them. So net, the sector has been a good sector, is given decent returns to all investors, including dividend return, capital gain, buyback. If you add all it up, in a good days, bad days, Neeraj, the sector has consistently delivered without the hiccups. So as a good investor, it's an integral part. Now, it's not going to give you a 1-year return of a defense stock of 71% or 3 times a 4-bagger. But what it'll do for you, it'll consistently compound your wealth at 20% plus year on year in a foreseeable future. No debt, corporate governance issues are not there. The companies are doing well. They know the cost structure. AI is going to reduce the cost structure. The relationship between employee and the company has changed dramatically from being totally dependent on an attrition-based, performance-based price model of salary increases to the point where people want to stay back with the companies. All in all, as a sector, I think you continue to be in this. But yes, you have to be patient with it to say, if you're a happy investor, and you've got to be very happy because 20-25% compounding year on year is not easy to get. It's a wonderful sector to be. But you got to be patient. It doesn't give you spectacular returns. It may not show up on the circuit filter every day. But what it'll do is, at the end of 5 years, it'll show up quite well on your returns index. But as I always say, limited money means you deploy your money to the highest returns. On that count, unfortunately, IT doesn't make the cut because several sectors in the economy will give you better returns for your limited money. So nothing wrong with the sector, good returns, but in context of what's available in the market today, I would not put it as a P1 priority for people to rush forward and say, all is well in the sector, let's go invest.
Is it my imagination or is Ajay Srivastava sounding a bit constructive on risk assets currently?
No, I'm just because I tell you what is happening here today. The Indian IPO market has given rise to so many stories. The restructuring paradigm, which is how come you see Reliance, you see Grasim, you see Raymond, which has unleashed value of almost a multiple of 3-bagger in a 2 years time frame. There are so many interesting stories coming up in the market that you all need to understand where to deploy your money, because you have limited money unless somebody has unlimited money and you want to do what you have to do. Spend it on things which nobody wants to hear about. But leave that aside, that 1.001% people, we all have limited corpus. When you deploy where we get the best returns, there are so many good quality stories coming in the market which give very good returns in the market. And therefore, relatively speaking, your capital would be well deployed in newer stories, restructuring stories, than in a old model of IT. And if you really want to do IT, I tell you what, just buy the index. Index has done wonderful. Our Nifty index has given a compounded return of 25% year on year for the last 5-7 years. No risk. Darwin theory, they weed out the old thing. So why go to IT? It'll give you the best of pharma, best of industry, best of manufacturing. If you really want to buy IT index, I would say bet is you better buy the Nifty. You'll get a better return.
Okay. Ajay, just come in on this. Does the US inflation data that came out yesterday strengthen the argument for risk assets in Indian equities too, by and large, and thereby even some of the tech names?
You know, in all our discussion now, whether we, irrespective of our interest rate, the general feeling everywhere is that Indian markets are overexpensive, priced higher than what they should be, which could be possibly is true. In most cases, is true. And therefore, the paradigm abroad is book profit, then to do substantial new investments. So I'm not sure whether the interest rate scenario is going to change the view about India per se. And as you can see, the divestments have been large and furious in the last 1 year or so, and a lot more is sitting in the pipeline. So, so I would tend to believe that we are getting constrained of getting foreign direct investment in this country because our valuations are at a level which nobody wants to put money in except for Indians at this point of time. And that's what is affecting us today. Now, how long will this standoff continue? One doesn't know. But it's very clear that there is a standoff in the market. Indian investors feel comfortable putting the money at these valuations. The US investors and global investors are not comfortable putting in their money. Now, I don't think that will change very much with interest rate scenario, but what can change is, and I think that's what is going to happen. I think that some amount of consolidation in India play, some amount of change in the budget stance from infrastructure to consumer to empower more money in the hands of consumer, possibly could change the dynamics. But if everything remains the same and budget is a blueprint of last year, I doubt that the mood from abroad will change very much to invest in India at our valuations today.
Got it. Ajay, so having said that, if you are a longer term investor wanting to be in equities, and as I heard you say that, okay, don't choose IT, fine. If you're a nimble investor, you want to put where the puck will be moving. Where is it that you find opportunity? In the past, you've given some completely non-consensus ideas which have worked beautifully. I remember tea stocks. I remember some of the agri and other agri-commodity stocks. Now, where is it that you believe the biggest bang for the buck lies if somebody has more than a 12-month, let's say 18, 24, 36-month view?
I tell you, engineering, IPO stories is the two places that you can be this thing that lots of new companies have come up in the engineering sector and new IPOs. I think those are the ones because with the fresh money in the kitty and the listed, these are almost debt-free companies. They've got good markets, global markets. And the best part, Europe is selling out in auto market. Lots of companies in Europe are not doing well. They're family-owned companies. They're all selling out. If you follow the trajectory of India's largest ancillaries, I'm not saying recommending it, but just give an example. Motherson Samvardhana. He has bought so many companies, but if you look at the back of the companies, all were mostly family-owned. All were not doing well. Family was not interested. They had good orders from large multinationals, and therefore he has swooped in them and picked them up and is doing very well. So I would say engineering, auto, I think are two big name theories which should work well for the next 5 to 7 years. And we will be large. I'm telling you, we will acquire a lot more in Europe in the next couple of years, and we'll become the largest supplier to the engineering auto market in the next 5 years. It's very visible. That's one sector which is coming out very clearly that is going to give us the very good returns.
Ajay, can I just get clarity here? No, completely. I'm loving this answer, but I just wanted clarity here. So are you saying, for simplicity, auto components which are into autos as well as some of the other divisions now that they've branched into, right? Are those the companies that you're talking about?
Those plus engineering companies. We just had an IPO for a company which does turbine blades. Now they do it for the windmills, but they're now gone to orders for aerospace. Now suddenly that changes the dynamics of the company altogether at this point in time. So auto and engineering, I would put as one block, which is going to give us phenomenal returns in our view. A consistent market, global players, we are already there, but we'll become much bigger and superior returns. And in them, you see lots of new stories coming up in IPOs. So lots of smaller hidden gems are being discovered. We had an aluminum company being listed in the last 10 days. We had a turbine company listed in the last 7 months. So, so the theme is engineering, auto, even present auto ancillaries. They are doing a tremendous job at this point of time. So as a sector, I think it's a great place to be, great place to park your money. And you are playing a game both India and global in these companies. And you're not very worried at this point of time whether how many EVs got sold next month or tractors got sold or not. You are now talking about global market, and you're talking of all these companies, most of them have long-term contracts with global players. So, there'll be a company with a subsidiary, we'll see, Mercedes-Benz has given a 5-year contract, or a Boeing has given a 5-year contract, or Airbus has given a 3-year contract. So none of these are transient. Every month they have to go and sell the market. All of them sit on large contracts, and that is why they are consistent multi-baggers in the market. You saw the Spanish company, Auto and Company, which has done phenomenal for the investors. So engineering, auto, I would put at one block. And also, please look at the new IPO stories. Each of them comes out with a gem, and there are at least 30, 40 in the pipeline. So they're going to be good supply of paper. So for investors, it's boom time. That's what I said. There's so much coming your way, man. Why would you want to sit with a foggy investment?
What has impressed you the most, Ajay, in the IPO pipeline thus far, or IPOs that have come out thus far? Because each company is a bottom-up idea, right? You can't paint it with one brush.
I think one of the most, I'm not recommending it. I had it so just for purposes. I'm saying I think Azad has been the most impressive debut in the market, and his plans are just phenomenal, absolute phenomenal. And please don't take it as a recommendation, because this is again the company aspect. Turbines, it already addresses the market of turbines, wind blades for the market, okay? But it has moved on to wind blades for the aero market. Now that's a niche. That's a market which we're talking about EBITDA margins of near 60-70% EBITDA margin company. And he said what? He wants to grow his capacity by 7 to 8 times. We're not talking of 7%, 70%. We're talking of 7 to 8 multiple capacity increase. Sure, there are risks. Sure, there'll be slippages. But that's the vision. That's the kind of company that gives you comfort that, yeah, if I want to bet my risk money, this is the kind of company you want to bet your risk money with, who think in a vision of being global suppliers of high quality, highest end product, and with a margin of 70%. It's just unbelievable.
So, Ajay, would you say, therefore, that the right lens to look at some of these businesses is not just from a perspective of FY26 PE or EV EBITDA multiples, but extend it a bit further because the growth rates can stay higher for longer?
You have to. And I think that there's a lesson. If you look at the global PE investors here in the last couple of years, all of them, you'd punted for companies over 4 to 5 year vision, and all of them made superior returns in secondary market. All of them, PE fund, if you look at the track record, if you look at the track sheet of them, the global PE funds, I'm talking about large investment, they made a multiple of 33% IRR, 44%, 50% IRR, and thereabout. And if you take the investors in the fund, in the companies like new age companies, it's multiple. It's not like 40% IRR is growing 10 times, 20 times. So as a prudent investor, we also should take the same view that good things will happen, bad things will happen in a year, quarter, next quarter. But at the end of 3 years, do you see this company positioned as a global competitor, as a strong Indian player with strong margins? I think that's the bottom line at the end of the day. If you feel comfortable, I think this is the market where you can be most comfortable with. That's why I said engineering auto is the market where India will lead at this point of time. And I think if we get some incentives on, labor, land, and other stuff in the budget, we will do exceedingly well. So all in all, I think we have a great story in India out there. And I think we need to play it just the way pharma played out once upon a time.
Got it. Wow. Well, this calls for maybe a conversation yet sooner rather than later, Ajay, because we'd love to maybe do a conversation only on what is impressive from a new age company perspective or a newer listings without getting into recommendations, just the nature of the businesses that some of these companies might be having. Looking forward to do that conversation soon, Ajay. Thank you so much for your patience today with us.
You're welcome.
While you were waiting. Really appreciate that.
Have a great time.
Yep. That's Ajay Srivastava with some of his thoughts. That's all the time that we have on this edition of Talking Point. Thanks so much for tuning in.